Why do people who suffer losses in the stock market wait until the market rebounds up to the highest watermark it was ever at before they move their money out of the market? In this educational episode, I'm going to talk about strategic rollouts and how you can save tax by getting taxes over and done with sooner than later while account values are lower. And then you can ride the market back up again tax-free. Get ready, you're going to be blown away. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, and I've helped thousands of people optimize their assets, minimize taxes, and prepare for a comfortable retirement so that they will not outlive their money. What I love doing is helping people at retirement planning, which is totally different than maybe what they did for their retirement planning, get the taxes over and done with sooner than later, because most Americans, I find, have been duped into putting money into tax-deferred accounts like IRAs and 401ks, 457s, 403bs, being told to defer to some future perceived unknown advantage, and then they'll likely be in a lower tax bracket when they retire. Well, that has not been true or axiomatic now for more than 25 years. In fact, most people who save money that accumulate any type of a respectable retirement nest egg are not in lower tax brackets when they retire. They are in as higher tax bracket when they retire as when they were earning money, even if they have less income. Why? Because they were going down the highway with one foot on the gas pedal, the other foot on the brake pedal, and they didn't know they were doing it. The foot on the gas pedal is putting money in tax-deferred accounts. The foot on the brake pedal is killing your deductions as you went. You paid off your house. You don't have that deduction anymore, usually in retirement. Your kids are gone during your golden years, or if they move back in, you can't deduct them anymore. You're not contributing money to IRAs or 401ks anymore, so you don't have those deductions. If you're a business owner, you don't have those deductions anymore. And guess what? Taxes will likely be higher in the future. So this is why I sometimes tell people, what are you waiting for? When you defer, another synonym is to procrastinate. When is procrastinating anything turned out good? Well, see, if you put off paying tax until you're age 72 now, and then take RMDs, required minimum distributions, thinking you're saving tax, you better think again. See, so many CPAs and tax attorneys and financial advisors are very short-sighted. They're myopic. When they tell you to take RMDs, they're only looking at a given tax year. Oh, if you don't want to pay any more tax this year than necessary, just take out the minimum required distribution so that you don't get a 50% penalty. See, if you don't take out at least the RMD starting at age 72, the penalty is 50%, okay? And so they don't want you to be penalized 50%, but they're giving horrible advice, in my opinion, to most Americans, saying take out the minimum. I think you should be pulling out the maximum. Whenever I ask audiences when I speak throughout America, how many of you think that taxes in the future will likely be lower? I get nothing but crickets. How many think they're going to be the same? I get 1 or 2 hands out of 2,000. How many think the taxes in the long run, in the future, will be higher? And a sea of hands goes up. And then I say, well, why are you continuing to defer and postpone and procrastinate paying tax on those IRAs or 401ks to some future perceived unknown advantage and then withdraw your money when you're convinced taxes are going to be higher? That doesn't make sense. And they all sit there. And they just been following the herd. 91% of Americans follow the herd and put money into traditional tax-deferred IRAs and 401ks. Only 9% understand, well, if taxes are going to be higher in the future, it would be better to get the taxes over and done with before I contribute to a plan, pay tax on the seed money, and enjoy the harvest when I take out money tax-free. So am I referring to a Roth? Yeah. But if you've ever watched very many of my educational episodes on this channel, I admit I've never owned an IRA or 401k. Never will. but I've never owned a Roth IRA or 401k, and I never will. Why? Roths are a step in the right direction. Roths were introduced in 1997 when the government was hard up for tax revenue, and Senator Roth said, I've got an idea. Smart people are realizing it's better to pay taxes on the seed money and enjoy the harvest without tax. So let's name this after me. And when people convert from regular IRAs and 401ks to Roths, it will trigger tax, and we'll get a windfall of tax revenue now instead of waiting until people retire and start taking money out. And sure enough, they did it for them, not for us. It was a step in the right direction. But Roths still have too many strings attached. Your money accumulates tax-free after you've funded it with after-tax dollars, and you can access the money tax-free. But I've been able to do that now for over 108 years in the Internal Revenue Code using what? Maximum funded insurance contracts. And in 1980, E.F. Hutton introduced universal life, where you can take the least amount of insurance the IRS will let you get away with and put in the most money the IRS allows, and you can use it for living benefits. And then in 1997, Indexed Universal Life came out, and guess what? That has allowed me and thousands of people that I've instructed to be able to accumulate money tax-free, and every $1 million they accumulate during retirement can generate $70,000, $80,000, even $100,000 of tax-free income if they live to be 120. That doesn't even come close to what most asset managers tell you to take out of IRAs or 401ks. They tell you to take out only 4%, $40,000 a year out of $1 million nest egg. That's pathetic. And then you have to pay tax on the $40,000. Even in a 25% tax bracket, you're only netting 3% or $30,000. What would you rather have, $30,000 after tax out of IRAs in the market? Or would you rather have, $90,000, 300% more, 3 times as much money tax-free, and not deplete the nest egg? That's what a properly structured IUL can do. In fact, if it's properly structured and funded, it qualifies to be deemed a laser fund, which is the title of a book I want to gift you at the end of this episode. But let me get back to the point I'm making. So many people get so hung up when they see their IRA or 401ks drop in value because they're in the market, and the market drops 20% or 30% or 40%. And human nature is, okay, I'll move the money out, but I want to wait till it gets back up to the highest point it's ever been. What? The high water mark? See, in 2008, when people saw their $1 million nest egg go down to 600,000, it took 4 years before it came back up to $1 million. And then it's back up to $1 million. Now they want to start paying attention to getting taxes over and done with. And I go, what? You could have got your taxes over and done with on 600,000. Now you have to be taxed on $1 million, and now tax rates are higher. And they go, oh, golly, that was dumb. But people get paralyzed. They don't think. They don't reason. They get emotionally involved instead of logically involved in what they should do. So when you see the market go down, you ought to get taxes over and done with while your account values are lower, and then ride the market back up again with a laser fund tax-free. Because when the market rebounded in 2009, most of our clients locked in gains of 16% tax-free after not losing a dime in 2008. Most Americans took till 2012 to get back what they lost. A lot of our clients had double their money in that time period tax-free. So don't get caught up emotionally and, wait until my statements reach the highest point they've ever been in the past. Good luck. You're going to kick yourself. So how do you determine how much money to start taking out of those IRAs or 401ks? You don't have to live on it. You don't have to spend it. You're wanting to get the taxes over and done with sooner than later. This is called a strategic rollout, not a rollover. A rollover is going from the frying pan into the fire, so to speak. That's taking money in 401ks and rolling them over to IRAs and deferring until you're age 72 and taking RMDs. I can prove to you, you will pay taxes the rest of your life and your spouse's life, and then anything left over as it transfers down to your non-spousal heirs, they have to pay tax within 10 years. You'll be shocked how much you will pay in tax by stringing it out. No, you want to get it over and done with sooner than later in a 5-year period. So a good tax strategist will look at your situation. If you're a married couple filing a joint tax return, for example, I'm going to use the year 2023 tax brackets, but it doesn't matter what year you're watching this episode. This has been true for decades. Between $89,000 of taxable income up to $190,000 of taxable income, you have $101,000 of room. If you made $100,000, you've got $90,000 you could pull out of an IRA or 401k and only pay 22% in tax. That's probably the lowest rate you'll ever be in. Why not pay at 22? Because if you wait until the end of 2025, the Trump tax cuts expire, and if they don't do anything, the 22 is going to move up 3% to 25, which is actually a 13.3% increase in the amount of money you will pay out in tax. You have between $190,000 and $364,000 that you will only pay 24%. So if you and your spouse were making $200,000 of taxable income, you have another $164,000 of room that you could pull out of an IRA or 401k and pay only 24%. If you wait around, you'll probably pay 28% in the year 2026. And you'll pay 28% on more money than just getting it over and done with if your account values are lower. See, you need to be logical about this, because if you go from 24 up to 28 in the year 2026, that's actually a 16.66% increase in money that you'll shell out in tax. Let me just show you this, because it doesn't matter whether you're filing separate returns or you're a head of a household or a single taxpayer. There's room in those thresholds. But the Trump tax cuts are going to sunset unless they do something to change it. The 12% bracket's going to move up to 15. The 22 up to 25, which is actually, people say, well, that's only 3% higher. Well, if you're paying $22 on every $100 and now you have to pay $25, that's $3 more. $3 is 13.3% more than $22. If you go from 24% up to 28%, people say that's only 4%. Well, it's actually 16% more, okay? See, when we add all these up, if you're paying $28 for every $100 instead of $24, that's 16.66% more money you're paying out, because that extra amount of money, that extra 4%, $4 is 16.66% of $24. Does that make sense? See, a lot of politicians don't understand the negative impact. And that's why when they raise corporate rates from 21% up to 28%, and they go, that's only 7% more. No, it isn't. It's 33% more money that corporations have to pay out in tax. They used to pay $210,000 on every million of profit. Now they have to pay $280,000. That's $70,000 more. $70,000 is 33% more, okay, on top of the $210,000. And then they wonder why corporations are laying off people and changing to automation and raising the price of goods and services, because they can't afford to pay 33% more money in tax. So if this is resonating with you and you want to learn why it's wise to perform a strategic rollout sooner than later, and you don't want to get emotionally involved, well, wait until my IRA and 401ks are back up to the highest point that they were ever worth. Well, if you want to do that, why not ride the market back up again tax-free instead of tax-deferred? You will be glad you did. So explore a strategic rollout sooner than later. Get the taxes over and done with at today's lower tax rates and while account values are lower. And then you will be glad, because you will be able to ride the market back up again safely, tax-free. But if the market ever crashes again, you won't lose if you use indexing, which is a strategy that I explain on this very channel. In fact, if you want to learn more about it, here's how you can study and learn. I want to gift you a copy of this book called The Laser Fund. It's a 300-page book, which is actually 2 books in one. This one is about 200 pages, 14 chapters with all the charts and graphs, explanations if you're a left brain learner. If you're a right brain learner, you flip it over to this book. This is 100 pages, 12 chapters with 62 actual client stories. If you want to use both the right brain and left brain, I would recommend you read both of these books. But This is designed to help you understand how to diversify and create the foundation for a tax-free retirement so you will not outlive your money. Now, you can claim a free copy of this. It retails on Amazon for $20. No, I will gift you a copy. You simply go to laserfund, laserfund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will pay for the book. I'll fire out a hard copy to you via priority mail, okay? But while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video versions of this information. Also, check out some of our educational webinars that we teach on a regular basis. They're free. And if you want to have a free consultation and analysis with an IUL specialist with no cost or obligation, you can schedule an appointment to talk to a specialist that knows how to do this correctly, because I've taught them how to do these tax strategies to save you like I've saved thousands of people. Some people I saved $250,000, $500,000. We saved one couple $1.2 million of unnecessary tax. We took one couple in California from the highest tax bracket to a 0% tax bracket in 5 years. You don't want to kick yourself because you didn't act, okay? So claim your free copy, and here is to your brighter future.